Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm joined with a returning guest, Dan Rasmussen. How you doing today, Dan?
Great. Thanks for having me back on, Kirk.
Yeah, glad to have you. Well, lots changed in the world since you came on last. Yeah, I know, and you wrote a new book. So tell us you know, for those listeners who didn't listen to the prior interview, tell us a bit about your background. It's pretty interesting.
Yeah. So I run a hedge fund called Verdad. We manage about 1.1 billion across microcap, deep value, credit, and then market neutral, long short. I started at Bridgewater and Bain Capital. I think I've, over the past 2 years, I started the firm in 2014, and we write a weekly research note, which we've been doing since 2015, so 10 years now. And that forms the basis for the book, The Humble Investor. It's all I've learned in the last 10 years. And I think it's part of our approach as a firm to be constantly studying markets. I think of myself as a think tank that makes bets. That's what Verdad is. So all of our research feeds into the things that we're making bets on in the market, and that's what I love about investing. And it's fun to be on this podcast because I know that you are also a sort of deep thinker and student of markets, and it's fun to talk about the way our research is leading us to different conclusions about what's going on.
Yeah, that's why we like having you. We like having people with with interesting perspectives. That's not just the drivel that everyone talks about, but people are really thinking outside the box. So what's of all the things that you're looking at, like what's the most interesting to you right now?
Yeah, I think, probably the most interesting is navigating the dynamics of the macroeconomy at the moment, which are really interesting. I mean, I think that you've had a number of what could be potentially the start of paradigm shifts. I think if you think about what defined the sort of let's call it the post 2008 world, there were a few things that sort of defined that post 2008 world. One was a very benign, low volatility market in which generally equities went, especially U.S. equities went up and to the right, where the dollar went up and to the right, where almost all the money was being made in growth stocks. So the valuation gap between growth and value went to new heights, and large cap in particular, where the Mag 7, the biggest names, were driving the market's returns. And this year, we're seeing some very different things happening. First of all, we've seen a shift where international markets have dramatically outperformed the US in 2025. And part of that is that the dollar has stopped its rise and started to fall relative to other currencies. And at the same time, we've seen a sharp increase in volatility. And part of that is this not self-perpetuating, but this recursive thing where the Mag 7 names are the biggest names, but they're also some of the most volatile names in the market. So as they've gotten to be a bigger share of the overall S&P, their volatility weight of the S&P is now almost 50%. So, the huge amount of the volatility of the market is driven by this very small number of names. And that dynamic, as the AI revolution, which we should talk about, has doubts have started to arise this year about how that's going to translate into the financial results. You've seen a big sell-off in those names, which has been what's driving the market down. And so what I've been trying to reflect on is, what's driven the market up and what's causing it to change, and how should investors be changing their portfolios, if at all? And what are the lessons we can learn from the study of history for how to evaluate what market signals are telling us at the moment?
Yeah, so I've been doing some reflecting recently on, I mean the Mag 7 making up a large portion of the S&P is no secret, and certainly it's been happening for a while. I did see a chart a while ago, which I thought was interesting because I hadn't thought about this, is that most countries have very concentrated large cap stocks. We're I don't know if we're the only country, but we're certainly one of the only big countries that have a more diversified public market. Um, and we've seen more concentration, but now things have changed. So what do you attribute the change to? And do you think that just the super concentration, the Mag 7 will continue?
Yeah, I think you make a great point, Kirk. Concentration is not bad in and of itself. In some sense, it's the norm. There are power law distributions everywhere, and there's no reason that market cap shouldn't be the same. I think what's sort of unique about the Mag 7 and what's been going on is that in the past, you were in a more normal pre the sort of super growth enabled by technology, where you could kind of grow to the moon, you could grow globally, you could scale without capex, which is what these Mag 7 names been able to do. Generally, the largest names were just the companies that had done best in the most recent cycle. They tended to then overinvest. There was too much optimism baked in, and so there's this cyclicality. And so if you were investing in the largest names by market cap, with the exception of sort of the Nifty 50 era, generally you were doing worse than being more diversified because you were rebalancing into the, darlings of the market, and the darlings of the market just would disappoint almost inevitably. Whereas what's happened more recently is that these Mag 7 names have just sort of grown to the moon. We've never seen companies of this size grow at this rate. I mean, we're talking sort of like 99th percentile growth outcomes for 99th percentile size market cap names. It's just kind of this crazy outlier in economic history. And so there's a reason those names have been winning. Now, what's changed? I think what's changed recently is that investors have come to better understand the AI business model. And the AI business model is a distinctly worse business model than what these companies were doing before. And let me explain that. When you look at what Meta or Google or these other companies were doing, it was infinitely scalable software as a service, very limited capex, capital light. AI is the opposite. It's highly capital intensive. If you look at the capital intensity now of these big AI hyperscalers, they are spending probably triple the capex as a percent of net income as the average industrial company in the US, right? So they've gone from being capital light, not spending any money, to massively investing in data centers and the electricity to provide those data centers and NVIDIA chips. The problem with capital intensive businesses is that those capital cycles are they create a lot of volatility. They create a lot of competition neglect, right? There are winners and losers in those capex battles. You get stranded assets. You get overinvestment. You find out that that the investment didn't pay off as well as it might have. And all of those things mean that what's happened is that these AI hyperscalers can no longer grow for free. Now they have to spend to grow, and they're therefore worse businesses. They're worse ROA businesses. AI is not a good business model yet, and even if it is a good business model, it's a worse business model than software as a service. And I think that's the dynamic that people are realizing, that they're getting skeptical of this capex spend, and they're worried about when AI will pay off, if ever.
Yeah, see, I mean, you bring up AI is interesting. I've put a lot of thought into this, and I wonder where it's actually going to go. Because, like you said, I mean, I love the way you put it was very succinct, probably a lot better than I could have put it. But, um, I've been hearing a lot behind the scenes. Everyone's talking in the surface. Oh, AI is great. It's going to do all wonders and it's going to, make the world a better place. Behind the scenes, I hear a lot of talk of like, why are we doing this? Well, it's kind of like ESG. People did it just to be cool, but it's not really a great idea. It kind of feels like people feel like they need to put money there, but it's not really paying off. Big corporations haven't really seen the benefit, as you kind of suggested. So, what is the AI in your mind? Where does the AI cycle look like? Because I mean, you look at Nvidia, it's gone through the roof, and I I don't know how it can continue at this pace. But where do you see the development of the AI cycle look like over the next like 5 to 10 years?
Well, no one's
Yeah,
smart enough to predict the next 5 or 10 years,
yeah,
but
it's a
but I
long
will
way.
say sort of what we're observing in real time and how to compare that to other industries. I'd say one, think about NVIDIA, right? Um, for NVIDIA to continue to grow, in some sense, the chips it has already sold have to depreciate such that the customers need to replace those chips, or the market as a whole has to grow massively. Um, so in either of those cases, the customers of NVIDIA have to be spending a massive amount more for NVIDIA to justify its valuation. And if you add up like the total profit pool of these hyperscalers, um, and you then like look at what NVIDIA's revenue needs to grow at, like this is going to consume all of their net income for years if these forecasts are anywhere close to being reality. And I think that that is what's kind of terrifying about this And I think the other thing is to your point, like where's the revenue model? Like where's the killer hyper profitable product that's making AI so valuable? It's like, yeah, I like using ChatGPT to like do ask it like stupid questions. Like I just looked in the fridge and I have a chicken and a piece of zucchini. Like what should I make for dinner? And that search probably costs, ChatGPT like $20 to answer. I'm like, I love it. It's great. But how is that profitable? I don't know. And like, like talking to an AI agent, like, yeah, it can probably trick you into thinking it's almost as good as like your standard Filipino call center employee. And that's probably cool. But again, like Filipino call center employees don't cost very much. So like, I'm not sure that the benefit of using this like hyper expensive, super intelligent robot is really there for the type of tasks that we're, expecting it to automate. I just am not sure the math works in terms of the cost of running these AI models relative to the benefits to the customer. And it's fine if VCs are willing to subsidize it. But if VCs aren't willing to subsidize it, the technology needs to get a lot cheaper fast for it to be economically viable.
Well, there's that, and there's the energy cost, right? I mean, we don't have cheap energy. I know that they're apparently Silicon Valley has pushed for this in our political halls because nuclear all of a sudden is on the table, even though it hasn't been for decades. All of a sudden now it's on the table, but that takes 10 to 20 years to build that out. So it seems like there's a bit of a pig and a python kind of here, where you've got this. It kind of reminds me of our demographics, right? The baby boomers and Gen X, and we have the millennials, and and it's just to me it seems like I don't know how, even if this was the cure-all solution for everything, and AI was just perfect in every way. I just don't see how it rolls out in the way that people expect it to in a perfect world, but yet they're pricing that in. So,
Yeah.
how do you? I mean, the first question is, do you even invest in AI? Like, do you even put that on the table at this point, or is it just kind of like, let's just wait and see, wait for the bodies to come floating down the river?
Yeah, I think we tend to be quantitatively driven. And when we look, from a quant perspective at these names, there's nothing all that attractive about them anymore. I mean, they're other than, momentum, but even now that's changed, right? So, and you used to love the return on assets, but now the capex spending has gone up so much, or, the profit margins are still great, right? The growth is still great, but the capital intensity has gone up, the momentum has gone down, and the valuations are sky high. There's just not a lot to like. And I think even beyond that, um, we have entered, regardless of what you think of Trump politically, Trump is a highly volatile president, right? He loves surprising people, and he loves keeping his cards close to his chest as part of his negotiating strategy. And when you think of how the market reacts to that, well, markets don't like surprises. Markets don't like uncertainty. They like false certainty. They like false sense of calm and complacency. That's what drives valuations up. And I think you have to understand, therefore, that a lot of people, whether through quant models or just through instinct, respond to volatility by reducing their allocations to things. If things become more volatile, people reduce their allocations. It's sort of an instinct. It's a quantitatively good instinct, by the way. And I think what you've seen is that the volatility of U.S. equity markets has gone up, partially because the Mag 7, partially because of Trump, partially because the dollar. Right? All of these things are driving U.S. equity vol up, and that's caused people to reduce their allocations to have more cash. And it's caused foreign investors, when foreign markets are actually pretty low volatility now, right? Like you think about like what is your stereotypical European company? It's like a bank or something, right? Like a boring, sock gen or something, right? Like these are the European businesses at the top of the charts in terms of market cap. And they're just lower volatility. They're just boring, less exciting, lower growth businesses, but they're a lot less volatile. And so as volatility goes up and people move towards safer assets, it's logical to shift away from the Mag 7 and shift away from the United States. And I think that's what we're seeing happening right now in part.
So I'll come back to the tech because I got some other questions, but you touched on international, and it brings up the interesting question. I've been hearing people talk about international for the last 10 years. What a great opportunity, what a great value Europe is. And yet it hasn't done squat. And it brings me back to, well, our culture here is very different economically than Europe. Europe does not have a innovative culture. It does not have a culture where everyone wants to be a millionaire. It's very different, and it seems as though if you look at decades past, there have been great decades and terrible decades. U.S. international, but the last 2 decades has been U.S. So one question is that paradigm changing? Will international investing, especially Europe, be the place to be for the next 10 years? Or is this just kind of a short-term blip because there's a lot of problems in Europe too?
Yeah, I think it's, the point about saying that international has been good for the last 10 years and that it not working, hits very close to home because that's probably about the length of time I've been advocating for international investing and basically been wrong. And I think it's sort of a fascinating insight. I'm a quantitative investor in large part, but I'm also deeply interested in behavioral economics. And you think about sort of the cycles of credibility or persuasion, right? Like, let's say, you're running a wealth management firm and you tell your client, let's be 50% US and 50% international. And the client says, you know what, Kirk, I really think we should be 100% US. I don't like foreign markets. They're too risky or whatever. And you start that in 2018 or 2020, 2015 or 2016, right? And then like the next year, the US outperforms. And then they're like, well, like I think we should go all US. And you're like, I don't know. I think some diversification is good. Like let's keep it right. And then 26 US outperforms. And like if the US outperforms like 14 out of the last 15 years, right? Like, who's going to have won that argument by the end, right? And like, this is real life. Like, you and I know people who have done this, right? Like, they're like 80, 90, 100% US equities. And like, they gave up on international. There are all sorts of reasons for why they gave up on international. International markets are not diversifying. It's like, well, if they're not diversifying, how could they have done so much worse than the US? Like, they're clearly diversifying. It's just bad. Or, again, Japan is a nursing home and Europe is a museum. And like, US management teams are just better and like there's no tech outside of the US and blah blah. Like I've heard it all. And like there's a grain of truth to every one of those things, right? I'm not arguing. I'm just saying that like that those people on that side have won the argument completely when it comes to asset allocation, right? Like and passive is added to that because when people go passive, they don't go into like the Vanguard Mid Cap Europe Index. They only go into the S&P 500 and the total market index. And so, you've just had this massive shift towards massive overweight in the US among most allocators and most investors as a result of US outperformance. Even if you were if you just didn't rebalance, you're massively overweight the US. And I think that the problem with this is that markets are it's not a game of investing is not a game of analysis, it's a game of meta-analysis. It's not what you think, it's what you think relative to what everyone else thinks. And when everyone else agrees and when everything is all beliefs are correlated and everyone thinks the same thing, even if that thing is right, the market overshoots. And I think that's what we've seen with this US international thing. The dollar has just gotten way too high. US equity market valuations are way too high relative to international. And a big part of that was international investors putting their money into the US. And what you've seen since Trump's election is international investors stopping the inflows into the US and now pulling their money from the US in favor of their home country markets. And that small shift in perspective has caused a relatively substantial shift in allocations. And we're at a point where like Apple is like probably bigger than the entire Japanese stock market. And like the Mag 7 is almost certainly bigger than the entire European stock market. And so you're like these, almost like a single stock move is like that's the dynamic we're looking at in terms of how these international markets are moving. And I think it's just no surprise that once we'd reached complete consensus and complete capitulation, where everybody knew that the US was the best market and diversification was really diversification, that's finally the point at which markets flip around because they're prone to do this, prone to bedevil you, and prone to take hubris down a notch, and had this massive shift in Q1. And the question is a broken clock right twice a day? Right. I mean, is basically this is just some minor short-term thing and the US is going to resume its ascendancy, or is this the start of a paradigm shift? And that nobody can tell you. But I think the weight of sort of the probabilities is on some sort of cycle shift in favor of international.
Yeah, it's funny you called Europe a museum. I was talking to my father-in-law who's not in finance, and he he made that comment yesterday. I just started chuckling. Never heard that. But yeah, basically Europe is a museum. Uh, Well, we talked about international, and it's funny because I had the same thoughts about value stocks. I mean, value stocks have been out of favor for like the last 25 years. I can't even remember. I think it was like the early 2000s, maybe this when they had a good year and they outperformed growth. Historically, they've been, on par with similar performance, but for like the last 20 some odd years, value's been out of favor, which all my friends are value investors. Just like I feel for them because it's hard to pitch when people can just put all their money in the Mag 7 and just forget about it. Um, but uh, one thing I was noting yesterday, because I was looking at some of the Mag 7 and realized Apple has a PE of 35 and they haven't grown their revenue in 3 years. And yet people still justify that.
Yep. Yep.
And it's this S&P, I think, has like a 34 PE and the average historical PE is 17.
It's
So
it's
like what I scratch my head when I think of this. I'm just like, it's not, I don't know what it's going to take for the bubble to pop, but I don't feel like it's a bubble, but at the same time it clearly is. So where do you see things going from here? Like how does this play out? I know you can't tell the future, but like, being a quant and looking at things with that kind of a lens, like how would you look at that market in a reasonable sense?
Yeah, I've been thinking about this, Kirk, about I want to write something about it, but it's too abstract. Maybe you can help me think about it. But I was thinking about like return patterns, like different shapes of different return lines. And one sort of thing we know, sort of as a stylized fact about expensive stocks, right? So you take expensive stocks. Generally, expensive stocks underperform the market once they've reached a point of being very expensive. But in order to get to being expensive, they have to outperform the market by quite a bit, right? Like it's just like so you have this sort of phenomenon where like you take a snapshot in time and like the expensive stock, has gone up and the stock market's gone here, and then you snapshot it here, and what it looks like is like the market goes like this and the expensive stock goes down. On the other hand, the value stock is in the opposite, right? Like it went down and the market went up, and then you freeze a point and it goes up and the market goes down, right? Like that's sort of the stylized fact. It's like, do you want to be right in the future or right about the past? And it's a sort of classic behavioral trap because, why do you invest in things? Well, you invest in them to make money. And so isn't the best proof that something's made money that it's gone up in the past, and the best proof that it's not a very good investment that it's gone down in the past? Like there's like this utility argument. And that's sort of the fundamental behavioral bias that drives this re-rating of value and growth stocks. And I think I can imagine the sort of, you know, um, the great investors of the 2000s, right? Like the people that we sort of grew up thinking of as heroes were almost all value investors, like Seth Klarman, Warren Buffett, et cetera. The reason that those guys were famous is basically they endured years of pain in the 90s, almost without exception, years of pain in the 90s. They underperformed. And they warned people. They said, don't invest in this mania. It's bad. It's dumb. And then they just had killer returns in the 2000s. And it's better to be right later and like you want to be right at the end, wrong at the beginning, and be proven right in some sense, right? Like that's sort of the return pattern that makes people famous investors, or at least did in the 2000s. And I think we're sort of seeing a similar phenomenon now, right? Where like the right trade has been like all U.S. tech, and like anyone who's touched U.S. tech looks like Midas. They just do, right? And like the more of that you did, the better you look. And markets just aren't that easy. Nothing outperforms forever. And I think we've just reached this level where this stuff is just so stretched and so expensive that, yeah, maybe I've been saying this for 3 or 4 years and been wrong the first two. But at some point, like, it just gets too absurd, too extreme, and things happen. Surprising things happen. Europe outperforms. Who would have thought that?
Yeah, I don't know. I mean, Germany, I can see the rest of it. Who knows? I mean, Europe's kind of a mess.
What about that famous Italian work ethic, Kirk? German food, Italian work ethic. We're in business.
I was in Italy when I was in college, and I was there. I think like pretty much July and part of August. Like, yeah, there was a lot of work ethic. They take half the day off. They work from like 9 a.m. until like 10 a.m. and then they come back for 3 to 4 to close up. Yeah, I don't know. Europe's interesting to me. But one thing that I find fascinating, because we're never going to solve the valuation game. Here's a question for you before I get into my next one. Um, a lot of people doing research on this for a while, um, and the concept. I assume you're familiar with the concept of the relentless bid, of just the money piling into index funds, and the index funds support the existing structure of what's in there, and then you've got more people putting money in, which consistently keeps supporting it and keeps buoying up these things, and the index money is the dumb money. Like they're not. There's no thought put into it. It's just we're just going to index because we don't know what we're doing, which is fine for most people. But is the relentless bid strong enough to keep supporting this crazy valuations, or are people this is the smart money big enough to be able to move the market at all to make those reallocations?
Yeah, I think there's two dynamics. One which is you've already seen, which is like one portion of that relentless bid has come from foreign investors who now comprise a large percentage of U.S. equity ownership in aggregate. And those investors have stopped adding money to the U.S. And are now net withdrawers of capital from the U.S., right? So like it's not like it'll change when the facts change, people's investment strategies change. And now you've still got all the automatic pension fund rebalance, defined benefit, right? Like all of this like huge machine, right? Which isn't changing. But you have to remember that the sort of standard of what those programs invest in and like the standard of prudent investing, right? Like that changes over time, right? Like if the US outperforms for 10 years, then it becomes prudent to put a larger share in the US, right? Like, so I think that I almost view these shifts are, um, uh, like people are picking indices instead of picking stocks now. They're picking allocations instead of picking individual securities. So I think we start to see the shape of the change around how people choose their allocations, how people choose their indices. And you start to see that playing out over time. And what percent people hold in cash or how aggressive they are about, all of these dynamics are happening. And so I don't think that the relentless bid is always going to reinforce the same structure. I think it will be return chasing to some perspective, to some extent. And I think you can't forget that there are all sorts of marginal players whose decisions do matter and therefore shape in a reflexive way those patterns. So I'm not as uh, uh, worried about that, even though I think it's a great description of the last decade.
Yeah. So one question I want to bring up. So I kind of geek out on marketing. So I got a lot of friends in marketing, and I was talking to one of them yesterday who was telling me that Google is testing out in certain zip codes a change in the Google search. And instead of going from the ad model, they're going to the lead model, where they're charging per lead instead of ads per click, um, which is interesting because I've been wondering with the rollout of AI, if you've seen their Google search, the first result is almost always an AI result, which to me means that the other search results are not getting seen, which means the ads are not getting seen, which means the revenues are going down. But eventually, um, I had this epiphany about, I don't know, 4 or 5 months ago. I was looking up some health stuff for my son, and I was just like doing some things. I was like, oh, I'll put this in ChatGPT because I heard on a podcast that it's really good at diagnosing medical stuff. So I'm like, oh, I'll just play around. I put some stuff in there, and oh my God, was it good? If I'm doing research, it's going to take me hours Google searching something because I Google searched this and then I got something over here. I'm like, oh, I got to look into this and I got to look into this. Hours and hours go by and I'm researching and I have to find the right website. I have to find a good website. I have to, discern whether it's real information or BS. All that stuff takes time. Whereas I could put it into ChatGPT and it spits out, I have to like tweak it a little bit with other information, but basically within like a really short period of time, it spits out a really good result. Why would I ever use Google ever again? I mean, that's the question that hit me. Now, the only reason I would use it, and this is what I do today, is the only reason I use it is if I'm looking up a specific company and I need their URL, I will put it into Google and it'll come up. That's it. I don't Google anything else. So now I know I'm one person out of, 300 million or however we got this in this country right now. So at what point does Google's infrastructure completely implode? Do they come back from that? Because if they're given an AI result, why them? Why not ChatGPT or Grok or whatever? So some of these big tech companies, do you think they're going to get, decimated in a large way because of AI?
Yeah, I think that well, think first, like think about that from like let's assume that Gemini, Google's AI model, is like the best in the business. Maybe it is, maybe it isn't, but like let's assume that. And so Google's saying, hey, if we switch from search to AI, we're still the winner here. The only problem is that Gemini search cost you so much more, cost Google so much more. The like gross profit margin on that search is so much worse for the AI search than for the old search. That's I think to me the problem. And then I think your point around ad conversion, right? Like, if I use ChatGPT, there are no ads in there. I don't know how they're they're not monetizing me in that way. They're monetizing me, I'm sure, in other ways, but they're not in that way. And so how does the business model have to change? I don't know. There's a lot of uncertainty. And I think what we've seen in past disruptive technological innovations is that there's been sort of a winner take all, and the winner that takes all hasn't always been the person that was obvious at the beginning. And I think if you look at, Meta, Google, Microsoft, et cetera, they're all spending as though they're going to be the winner. And probably not all of them are going to be the winner, and the market's probably not going to be equally split among them. And I think that that's the, one great challenge here, right? I mean, like, who will be the winner? And it is like we don't know if it's going to be profitable. We don't know what the business model is. We don't know who the winners will be. Like this is a very speculative thing. And look, speculative investments can be great, but speculative investments probably shouldn't be like 35% of your portfolio, right? Like which is what they are right now.
Yeah, no, I agree with that. And I think most people are just they've been lucky for a while and they're just going to keep rolling, keep rolling that keep putting it all on black. Hey, we're doing it again. Um, so let's get into I don't like talking politics, but obviously Trump is a big figure into, the paradigm shift you're talking about. How do you see I mean, based on whatever you think is reasonable, but how do you see the Trump presidency playing out economically? What changes do you see happening? How do you prepare for that? Because there's a lot of disruption, I think we all agree there. But like, um, how do you handicap that based on what you've seen so far?
Yeah, I find it very difficult, to be honest. I mean, I really don't know. I mean, like if you said, hey, the US is going to enact a bunch of protectionist tariff measures, wouldn't you have said I'd buy US stocks over international ones or US dollar over international? Like, and yet the opposite has occurred, and we can sort of talk about why, but it's very tricky to imagine how these things are going to happen. And it's also very tricky to know, how much of the U.S. sell-off this year is about Mag 7 AI capex fear and how much about it is tariffs. I think it's actually more about the Mag 7 than it is about tariffs. But that doesn't mean that this economic certainty isn't massive. I think that probably the most quantifiable thing that we can see is the impact of the cuts in government spending, because that sort of linearly flows into GDP. And if they cut as many jobs as they want to cut, that has like, what's the implication on the U.S. housing market or, the DC housing market, for example, or just, think of the percentage of hiring during the Biden administration that was government funded. Think about all the people that are going to get laid off in universities and government, bureaucracies, right? Like, and the flow through of that to the real economy. I think that's probably the most definable negative. And I know that Trump's team has said, well, we're trying to shift from public to private. Like we want those people to get rehired into the private sector. The question is, will they? And if hiring is strong and those people leave, the EPA and quickly get hired by, Monsanto, then we're great. But on the other hand, they leave the EPA and people are like, well, I don't need someone to like internally regulate my business for environmental problems or something, right? Then like, I don't know. Like that's a lot of new people that are going on unemployment, and I just don't know how that plays out. And then there's the question of, does that unleash some massive economic revolution among the businesses that don't have to deal with excessive regulation, or do the taxpayers immediately get a benefit? But we've had so much fiscal stimulus, right? We're so over our skis fiscal stimulus wise over the past few years that as that resets, it's almost sure to be a negative. And you can sort of think about the Keynesian multiplier in reverse, but it's not pretty. And it sort of has to happen. And I think you compare that to a lot of international markets that the governments didn't spend like drunken sailors, and you think, maybe they're in a better position.
Yeah, it's an interesting perspective. I mean, I know DC is obviously not going to do very well. It seems like it's probably mostly isolated in DC, which is not necessarily the same in other parts of the country. But we've had such a massive amount of government spending as part of the GDPs. Your point's great about like what happens when you kind of get off the crack pipe, which I think this is the part that I find interesting. Like, I know a lot of people that don't like Trump, a lot of people do like Trump, and the people who like him, they're like, yeah, this is gonna be great. And like the business owners are excited because they're like, great, we get rid of regulation and it's great for all that. But I I don't know. I always find it like oddly, funny. But anytime you think something's going to happen, you're almost better off doing the opposite. Like you said, like, you think tariffs, all this stuff with Trump, US only, US going to do great. Nope. International is clearly outperforming by like 20%. It's just like not even close. 30% actually close. Um, so I almost find like sometimes it's just better to do the opposite, even though it's not logical. I wonder with so the things I've been hearing about Trump, like behind the scenes stuff, some that's kind of coming out with some interviews and some podcasts. I feel like there's a lot more complexity going on that's not being talked about in public. Like it's not just like tariffs, or it's not just like we're gonna, fight Russia. It's not a singular thing. It's like, well, we're gonna do these like 10 things, and they're all gonna somehow work themselves out. Um, and the things I've been hearing have been very interesting. I don't know if they'll work or not because some of them are innovative. Like, I don't know, you hear about the Mar-a-Lago Accord that they're talking about?
Tell me more.
So I heard this in a podcast interview, and I thought it was really interesting. So what they were talking about was right now we require our friends, our international friends, to buy treasuries, and of course we pay them interest. And the conversation was, well, you're getting a free ride. We'll protect you, but we're going to issue 100-year paper at 0% interest. So all of a sudden now our interest is no longer our biggest line item. We can whack that off, and that gives us a lot of flexibility. And I was like, that's interesting thinking. I don't know if they'll go, but it's like, okay, that's outside the box thinking, right? And so I hear ideas like that. I'm like, well, I'm curious how that's going to work, but I'm I'm open to the rosy side, but I also don't know. So I wonder how long do you think? Because we had Trump before, so we kind of know what we're going to get a little bit. Um, you know, do we think that if your internationals start to do well, but do you think that it's better to be international, even though um, it's possible that the U.S. could really free up a lot of, no longer have the government spending and maybe solidify some of the big problems that are going to hit us in the early 30s, like Social Security, Medicare, and pensions all run out of money. Do you think that, if you had to bet, like where would you think is kind of most probable?
I think that I think at this point the international markets are just much cheaper, much less volatile, much less risky
Yeah.
than the U.S. market. And I even think like de-emphasize Trump. Like Trump's going to do what Trump's going to do. It's of course it's creating policy uncertainty. Of course that has its impact. Of course that's increasing volatility, and that's part of the reason that international investors are pulling their money, et cetera. But what Trump does pales in comparison to the AI question in terms of what's important to markets. The market is again 35% of the S&P weight is in the Mag 7, and probably 50% of the volatility weight of the S&P 500 is in the Mag 7. All that matters is AI, and how that plays out. Like tariffs, like let's say he introduced some draconian tariffs, right? The net impact on prices in the U.S. would be like, okay, prices go up 2 or 3%. It's just not huge. It just isn't, and it's in very specific places, and who knows what the economic impacts are. Um, uh, I just don't think I think it's going to consume a lot of pundit time, and drive volatility and drive international asset allocation. But it's this tech question and the sort of outperformance of tech and the valuation multiples attached to tech, that are the key market drivers in my mind. And that's why I'm so focused on valuations and valuation comparables, and the question of whether AI is going to be profitable.
All right. Well, talking about international, where do you think the best markets are if you had to pick internationally? And as a side note, if this doesn't come up, I'd love to hear your thoughts on Japan, which has always been kind of my head scratcher of what a great value, what's going on.
Yeah, so I'm very excited about what's going on in Japan. If you think about what is going on in Japan, or the typical Japanese company, there are a few sort of stylized facts you should know about the standard Japanese company. One is that there are a ton of really small Japanese companies, right? So like almost every company is public that can be that has some minimum scale is public. It's very prestigious to be public. So like most of corporate Japan is public. Those companies tend to be inefficiently run by Western standards, which means they have low return on assets and low margins, and they have huge bloated balance sheets from a Western perspective. They've got huge amounts of cash on the balance sheet. They've built up massive random investment portfolio, generally these cross shareholdings. They have huge real estate portfolios. And what that means is these companies are very stable and safe. That's why they did it, right? That they just, they're sort of these castles. They have fortress balance sheets. Like every single company, like your random like paper and pulp mill or like, iron trader, like they've just got like, 200% of their market cap in, random balance sheet assets. Um, and I think that that makes these things really safe, but it also means that unlocking value has to mean balance sheet change. And what we're seeing now in Tokyo is that the Tokyo Stock Exchange is putting a lot of pressure on companies to get to one times price to book. Huge percentage of Japanese companies trade at below one times price to book. And the way they need to do that is by rationalizing the balance sheet, converting balance sheets assets into dividends or into buybacks. And we've seen a first few successful examples of companies adopting this new dividend on equity approach, where they say we're going to pay out a percentage of our book value every year as a dividend, and maybe it's 8% or 10% or 5%. But when your company is trading at half of book value and you announce an 8% of book a dividend, that's a 16% dividend yield, and the median company trades at a 4% dividend yield, right? Like these companies reprice really quickly, and they can all fund an 8% a book dividend yield basically into perpetuity just by selling off their real estate, selling down their cash, and selling down their cross holdings. And so I think what you're starting to see is the first wave of companies sort of figuring out how to unlock that, and their stocks going crazy. And that example kind of spreading to other Japanese firms. I think the season, Q2 is going to be very interesting because they have all the annual meetings where the companies announce their, 2020 fiscal year 2026 plans. And I suspect we're going to see some real fireworks in terms of some of these reform proposals getting pushed through.
So, the big question that kind of comes to mind, because I've been hearing about Japan for the last 10, 15 years, and it's certainly they had their Great Depression for 32 years, whatever it was, that the markets were negative. But the big thing that always kind of the big whammy is the currency. So how do you, I mean, a lot of people talk about investing in Japan, which is great, but you get this currency issue, which is this big black mark on the whole country. How do you handle that?
Yeah, so I mean, it's interesting. So the yen is a flight to safety asset. It's always lower yielding than the dollar, and so if you think of sort of carry trade, right, you're borrowing in yen to buy dollars. And so what you've seen over time is that the yen is quite highly correlated with U.S. Treasuries. So when Treasuries are doing well, the yen is doing well. When Treasuries do badly, the yen does badly. And obviously, we've been through a period where the yen has devalued dramatically, and treasuries have obviously done terribly. But the good thing about that is whenever there's a crisis, the yen rallies. In '08, the yen rallies massively, for example. In COVID, the yen rallies. So you're getting this sort of inverse correlation with the equity market. When the equity markets are doing well, you're losing money on the yen. When the equity markets do badly, you're making money on the yen. And I think from an investor perspective, that's dampening your volatility. And it's basically, if you assume that the currency is sort of a neutral over long periods of time, then, in theory, you're just improving your Sharpe ratio by owning it unhedged in yen. So I like the yen exposure. Like, yes, it's been bad the last few years, but it doesn't mean it's going to be bad forever. In fact, it's being good this year. And I think in a crisis, it's going to be very, very good to own yen.
Let me ask you this, because I've never actually thought to ask the question, why is the yen a flight to safety? Because it's kind of a disaster in currency standards. So why do people consider it a flight to safety, especially over other currencies, which may be, in my opinion, a little bit more stable?
Yeah, I think I mean I think you just like to make like sort of the bond analogy, right? Like the lower yielding the bond, the less risky the bond is. The more higher yielding the bond is, the more risky it is. Because inflation is the biggest risk to bonds. And Japan is a perpetually low inflation economy. Japan always has the lowest bond yields. The other one is Switzerland. But Switzerland and Japan are always going to be the lowest yielding currencies because they're least at risk from inflation. And you contrast that with, say, Brazil or Turkey or something where the risk of inflation or destabilization of the currency is massive, and you're going to get massive yields. Of course, in a flight to safety asset, you're going to move money from the Brazils or the Turkeys of the world into the Swiss francs and the yens of the world, and that's what you see happening. And the dollar these days is sort of in the middle. It's higher yielding than say the Canadian dollar or the euro or the Swiss franc or the yen, but it's obviously not an emerging market currency either. But in a flight to safety world, again, you're going to go down the yield spectrum to the lower risk currencies.
All right. And one more area I want to touch on before well, actually two more areas before we wrap it up. So one is gold. Gold's been doing very well. It seems to constantly defy expectations. Uh, I thought the last few years gold had been doing great, and up until like, I don't know, the last 6 months, it was pretty much going sideways. So, what are your thoughts on gold, and how do you look at gold in an overall kind of allocation?
Yeah. So in our multi-asset, market neutral strategy, we have a 35% weight to gold right now. So just to give you some context, we're
Nice.
pretty bullish on gold.
High five.
I know that's been good trade. We've been pretty long gold for a while. And I think that if you think about why gold, first of all, no one knows how to predict the returns in the short term of gold. It's a complete mystery, okay? Like why it goes up or why it goes down, try to correlate it with anything, and you're going to come to like, I have no idea. But there are a few things we do know about gold. One is that it does maintain its purchasing power over time. There's a famous paper by Campbell Harvey that shows that the price in gold that you paid a Roman centurion in like 0 AD is the same price you pay a U.S. Army captain in gold today, right? Like, so gold maintains its purchasing power where no other thing does. And so, you're not going to make any money on gold, but as a store of value, gold is an excellent store of value. Probably, equivalent to or better than treasury bonds or treasury bills in terms of preserving purchasing power. The sort of next thing to know is that when inflation spikes, right, like, and people are looking for a flight to safety asset, gold always looks good because it's not at risk of inflation, whereas bonds are. And I think then you think of like, okay, people need a low risk asset in their portfolio. And so if there's a demand for low risk assets, and then people have two options really are gold and bonds. If bonds haven't done that well recently because there's been high inflation, people are going to go to bonds. The other thing that happens is this reserve currency purchasing, where if you're worried about the terms of trade, if you're worried about getting shut out of the US financial system or whatever, right, you're going to buy gold, you're going to diversify your foreign currency reserves. And I think that's what we've seen a lot of foreign governments do in the context of this political instability. So I think the sort of recent rally is probably in large part driven by central bank buying outside of the U.S. But the logic of owning gold in a portfolio as a low risk asset, as a diversifier, is very strong.
So do you think that, and I have to ask because I know, I mean, the central banks was part of my question is, do you think most of it's coming from central banks? Because silver has drastically disappointed for quite some time, and everyone talks about it, the gold to silver ratio. It almost feels like silver is just a non-issue anymore when it comes to inflation hedges because it's not only confusing people, but it's doing the exact opposite what you'd expect. Gold goes up and silver just stays flat. So I don't know what your thoughts are on silver.
Don't trade silver. I don't know a view.
Okay. Yeah. Just curious. I mean, it,
Maybe that's the problem, right? It's just not
yeah.
salient enough. People don't think about it, don't trade it as a macro instrument the way they do gold.
Yeah. Okay. Um, All right, and then I guess the last question I had for you was is the most important one, small cap. What's going on with small cap? It's been
Gosh,
off
I wish
everyone's
I knew.
radar
It's been a
forever.
disaster. Almost
How's-
everywhere. Size has underperformed for years, almost regardless of market. At least value has done well internationally, right? So people talk about value underperforming. Value has underperformed in the U.S., but it's outperformed in the international market. And so, like, there's a saving grace to value. But size has basically gotten schlonged everywhere. No one likes small caps anymore, and I just don't know why. And the valuation gap between small and large has gotten massive. The valuation between micro and small has gotten massive. And so, you're in this world where there's like a massive number of super cheap micro and small caps, and no one seems to pay attention, and the market doesn't correct. And I don't know when that's going to change. And part of the knock on these small caps is that they're very volatile too. So it's like if they've underperformed and they've had higher volatility. It's just the worst of both worlds. Like when the market's gone up, they haven't gone up as much. The market's gone down, they've gone down more. And I think people have been burned. And yet it's sort of ironic because at the same time, everyone's favorite trade is to put 40% of their portfolio in private microcaps. So you're like, if any of that money would shift back into public small and microcaps, which are probably, an equivalently sized market, no one's putting 40% of their money in public microcaps. But if that started to happen, or if there's even a small shift in that direction, I think it would be very beneficial.
It's funny you said I never thought of that. I never really equated the microcaps to the private equity realm. It just never hit me, but that's so true. Um, I wonder how much of this is the institutions moving the markets around. Because if people are putting all their money in indexes, they're not picking stocks like you are. So maybe that, and I've always thought like that's really the problem. It's like, if you find some great companies and nobody knows about it, they're not going anywhere because there's not enough money floating in there. So I guess the question I would ask you is, I mean, there's definitely values there. I mean, I know you're in there, and I know some people are doing fairly well, but in general, do you really need that adrenaline shot of institutional money to make that asset class work anymore?
I don't know. I mean, I think, again, if you sort of went back and you said, hey, I have a very simple hypothesis, which is that people are going to shift towards passive. And as people shift towards passive, the money will disproportionately flow to the largest stocks. And therefore, my strategy should be to own an overweight to the largest stocks and underweight anything that's like under indexed. Like you would be a total genius. Okay. Like that would have exactly worked as like a predictive model for trading the market. And so in some sense, like I'm tempted to just sort of say, yes, like passive is the reason why small cap has sucked. And yet at the same time, like actually proving that is a little bit hard. I just don't know. Um, uh, and I think that, but I think, in markets as in life, nothing continues forever. The pendulum always shifts back. Things that get under love for too long get so cheap they become loved again. And these things are all cyclical. Like talk to anybody over the age of 70 who's investing in markets for a long time, and that's what they'll tell you. We've gotten so caught up in a very simple paradigm that everybody is overweight, and it's too good to be true, and it won't continue.
Yeah. Awesome. Well, Dan, I always appreciate you coming on the show, sharing your wisdom. I always enjoy our conversations. Um, any final thoughts and where can people find more about you?
Yeah, if you want to learn more about me, I'm at Verdad Cap on X, and in my bio, there's a link to our weekly research we write every week. You can buy my book, The Humble Investor, on Amazon or anywhere books are sold. I'd very much appreciate it if you would buy the book. I think you'll enjoy it.
Awesome. Awesome. Well, I can't wait to read the book, and I do get your emails every week, and they're awesome. So for anyone listening, sign up. They're great. They're great knowledge for the weekly reader. So Dan, once again, thanks for coming on the show. Really appreciate it.
Thank you,
And
Kirk. I appreciate it.
yeah, we'll have you back on in the future.
Excellent. Thank you.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room, as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right, well, that was a great interview with Dan. Really appreciate him coming to the show. Now we're in the panel portion of the show where we have our very own Doug Hagren. Hey, Doug.
Hey, Kirk, threw me off because I think normally when you have some you announce the other panelists first. I wasn't expecting to speak here, but yeah, it's good to see you today. Good to see you, Megan, and excited to be on again. Thanks.
Well, Doug just ruined the surprise. We have a surprise panelist. We have our very own Megan Gorman, who's come back.
Hi, it's good to see you guys. It's nice to be back. It's been a while.
Megan was on vacation.
Yeah.
Vacation by
Unfortunately, I've
working.
been
For a
like a
couple
lot of
quarters.
like a lot of people. I think I'm drowning in caretaking for parents. So I think I've don't tell the taxing authorities, but I think I've spent more time in New Jersey than California over the past 6 months. So it's been wild.
Which has a better tax rate? You know,
It it depends on income level. You could argue Jersey, but then Jersey crosses over and becomes higher than California ultimately. It's sort of crazy. I think Jersey's top bracket, I want to say it's close to 15%. Yeah, I
Wow,
mean it's something
that's crazy.
top income bracket. Yeah, New Jersey's top income bracket, I'm sorry, it's 10.75, it sounds like.
No, it's already lower than Minnesota. I was gonna say, don't if it was 15, don't tell Minnesota because they want to be California, but they might decide they want to be New Jersey. But the good news is that you can take a look at where you're going to be, and based on that time you spent, you might be able to declare yourself a resident of New Jersey this year or state California, and it doesn't matter anyway because there's no IRS agents to enforce it.
But the state taxing authorities have been hiring from the IRS. So I have a feeling the
Ah,
states are going to get a little more aggressive. And where California is weird is Jersey has a days in requirement, right? 183 days and you're a resident.
I stayed in a
California
days in
is far
before.
trickier. Um it's facts and circumstances. So I
Okay.
could look like a resident of California regardless.
Yeah, okay. Yeah, but Minnesota has a tax called the use tax, which basically means, oh, hey, looks like my camera fell off non-stick there. Okay,
It looks
hanging and
like you're
hanging.
swinging volatilely like the markets.
Yeah, yeah. Came detached. Um, but the use tax basically is a catch-all. It's like, well, you didn't pay sales tax on these things, but if you use this, and this, we've got this other catch-all. And it's like the number one thing that Minnesota will catch people and audit them on is people not declaring enough use tax, and they are aggressive. I think they've taken two or three people who have but happens is, we got the snowbirds. They moved to Florida and they're like, "Hey, I'm a Florida resident," but they still got their cabins and they still got all this. And then they come back and take them to tax court. And I think they've won three national cases. So Jersey, Minnesota, California, yeah, you don't want to mess around with those state tax authorities. They take it very seriously.
Yes, they do.
Well, that's a lesson to all of you. Make sure you pay really close attention to where you retire or have your homes. Uh,
100%.
I mean, we lived right next door to New Hampshire, and I know over the years, people have been able to get away with stuff. But I know Taxachusetts, it used to be called. It's no longer has that moniker because now everyone else has a higher tax rate. But They are pretty rigorous about about their collection. Not as bad as California though. We when we started our firm, just for reference, we'll dive into the topic. We started our firm within a few weeks. California sent us a tax bill of taxes that we owed. We had just started the firm. We hadn't even made money yet, and they already sent us a bill for what we owed them. And it was like, we don't live here. We're not even licensed in your state. We have no clients in your state. We've never done business in your state. Like they were sending them across the country to everybody that they could find, just sending
Prove us
bills.
wrong.
Right.
Yeah, that's
And this is
what were they sending you a tax? That's wild.
so here's the thing. So I just ignored it and I was just like whatever. Like, if it's really a problem, they'll send me about 50 more notices. So I just ignored it because I know we hadn't done any business at all in that state. But here's the thing. So Massachusetts about 15 years ago, I think it was, somewhere around there. They had this issue. So I was talking to my accountant, I was doing my taxes, and I was just sitting there just having a chat with him. And he was telling me the story. He's like, I just went to a seminar, and we had the head of the Mass DOR speaking, right? And it was a bunch of accountants all sitting there. And the guy speaks, and at the end, he's like, all right, any questions? One guy raises his hand. He's like, I don't know. I got a question. I've been getting a lot of tax notices for my clients for taxes they don't owe. And he's like, okay, yeah, we know what you're talking about. Sorry about that. We're aware of the error. Um, the only reason we haven't fixed it is because we're generating too much revenue from it. So basically, what he was saying is, yes, we know that people are erroneously being noticed for taxes they don't owe, but we haven't fixed it because we're making a lot of money from that, from basically screwing people over. I was like, you kidding me? Like, he told this to a room full of accountants. It wasn't a secret. He was happy to share it.
How is
I was
that different
just
than
shocked.
phishing emails? It's like,
Yeah,
hey, if we get enough people to respond.
but that's the thing. Like, it's like big corporations. They never make errors in your favor. It's always in theirs. You ever have that problem? Like Verizon, Comcast, all these big companies. Like, there's never an error in your favor. It's never like, the Monopoly card. Hey, bank error, $10 in your favor. No, never got one of those. It's always money you owe them, and then you got to fight them for $10. And it's like, so anyway. So that's the world we live in. But on to the important stuff. So. So Doug, what were some of your thoughts from the interview with Dan?
Well, yeah, so couple thoughts. I mean, to me, we've talked about this before. I mean, there's a difference between technical trading, fundamentals, and you can wait a long time for fundamentals to come around. I mean, value has been popular, or I'm sorry, value has been underperforming for a long time. And if you're a fundamentals investor, you would have thought you buy low, sell high, right? And get in there a long time ago, and that should have turned around. But yet things can last extremely long. I mean, international, one of the things that's doing much better now. He talked about the forgotten trade, international rotation. I mean, USP is near 35. You've got Europe and Japan sub 15. You've got, currency tailwinds, so for the yen and in lower inflation and lots of opportunity. But yet, how long have they been saying international is the place you should be investing because opportunities are really cheap there compared to US? But I mean, you could be sitting in international for 10 years now and never get anywhere. So I think one of the things that, there's a takeaway for me is that there is a tremendous opportunity in diversifying and looking at things that are lower value. I mean, again, expanded context, talk about today's Mag 7 is tomorrow's Cisco Intel of the 2000s. But unfortunately, there's got to be a lot of patience. And what's going on with investing, you've got, I mean, we're talking about, how long does it take? We've talked about this, a paradigm shift. How long does it take for a paradigm shift to actually rotate? I mean, we've been sitting here in just basically the Mag 7 driving everything for a decade, and with the Mags, not the Mag 7 in its current form, but it's really been a tech-driven world for a long time. And there's an entire generation that has not seen anything but technology drive these market returns. So I think that from one of my takeaways, and again, I know he's a big, small, and microcap. It's something, it's very mispriced. But again, how long has small cap values continued to underperform, and when will they actually be something that is going to turn out to be a better, a better opportunity in the portfolio? It's been very hard to be diversified in this market for the last decade, and I think we're finally starting to see it. I mean, gold obviously is doing really well right now. International has done better. Small caps, buying high quality small caps is kind of like paying for community college instead of Harvard. You're going to get similar results at a fraction of the price, but you've got to look past prestige. You got to do a lot of work. I mean, to get there as a whole, as an index, if you just buy the small cap index, it hasn't done anything for a long, long time. So I mean, it takes a lot of emotional fortitude to invest, especially as a fundamental investor in these markets over the last decade, because unfortunately, time and time again, what has historically been, the prudent way of investing has unfortunately been a value trap, or has been a trap for a long, long time. You talk about it. How long have we been waiting for Japan to come back? It's really really difficult to be an investor. So I think those are some of the things that I look at. All over the place is really coming down to, just a challenge of diversification, and you want to still be there because of risk, but it's proven people wrong time and time again.
Yeah. Megan, what are some of your thoughts?
So first of all, I thought the interview with Dan, he's a very thoughtful person about the markets. I do like listening to him, and I appreciate times when he's very honest about how he feels when he doesn't have a point of view on something, or he doesn't feel comfortable giving a point of view. Um, but in listening to the interview and then going to my experiences in client meetings over the past few months, and I say this at the beginning of April, so everything could change. A lot of what I'm finding in the market right now is dependent on your political affiliation, right? You go into meetings with people who are Trump supporters, they feel very optimistic about the economy. Or, they see it that there's going to be changes, but they're willing to ride the volatility to get to those changes. You go to meetings with people who are not Trump supporters, they are very panicked about the markets and the economy. And so I bring this up because we talk a lot about behavioral finance, but this is one of these moments where being very grounded in data is going to be important. And Doug hit on a lot of the big points there, right? And what I've been talking a lot with clients is, regardless of how you feel about the politics of the country, when we are in uncertainty, and uncertainty that we're not sure is going to be short-lived or long-lived, we really have to go back to strategy. And that goes back to diversification. And so as we sit here at the very beginning of April, because a lot can change, as I've been in client meetings showing clients where their portfolio is, people have been pleasantly surprised that they are flat or maybe up a little or even just down a little. And again, to Doug's point, it has to do with the international markets and how much international exposure people have in their portfolio. And I agree with Doug. This past decade has been very difficult to keep clients in international, right? I mean, you think about the last big time that international was a market people were dying to get into. I think we're going to go back before the 2008 crisis. I think it was like 2006, right? So what was shocking, like through the end of March, I think through end of March 28th, the MSCI EFA was up 9.2%. The MSCI Emerging Markets Index up 4.8%. And so a lot of people have been able to use that performance to mitigate some of the risks in other areas of the portfolio. So what Dan talked about really resonated with me, with a lot of the things he's talking about, because he talked about the rise of international holdings. And he said, look, they're cheaper. And at this point, they're less volatile. And if you think about some of the things that the Trump administration is doing, it's forcing certain countries to take action that will stimulate their economies. And I think we saw that with Germany. So this has been a year so far, things can change on a dime, where diversification is a huge argument. And so I'm having a lot of clients just focus on getting back to target, sticking on target, and at moments doing the right tactical tilt, whether it's to commodities and gold, to infrastructure, those key elements that can really help a portfolio over the long term.
Yeah, I mean, you mentioned the international part, Megan. So, Doug, I mean, when you're working with clients, I mean, the issue that always comes up is we all experience this. we try to diversify, and as Dan said, stuff just doesn't work. Value hasn't worked for 20 years. International hasn't worked for like 15 or 20 years. You know, like all these asset classes, like small cap, like there are times where it's just out of favor and people still want to diversify. How do you handle those conversations with clients, Doug, when you're trying to express diversification and yet they're just looking at, well, why don't I just put all my money in Mag 7? You know, like how do you handle that?
Oh, it's a great question. And I think one of the ways that I'm able to kind of get around that is I try to get the conversations away from the individual return of the investments in general and get back to the why. And this gets back to Megan's point about behavioral finance. Um, when I look at conversations with clients, I come from a different approach, right? I like it's like, look, there's three buckets of money. The first bucket of money is what you've already saved. Okay. This is what we're talking about here, your investments. Okay. I would say that 95% of the people in this business, they focus 100% on that. It's like, hey, you move that to me, I can get you a better rate of return, or I can reduce your risk, and we'll just work on that, manage that, whatever. And that's really important. You need to manage that appropriately. But generally, what that's going to do is it's either going to erode your return by being more conservative, in theory, because as we saw in 2022, 2023, more conservative meant bonds. Well, that wasn't actually safer. And those have been really, hurt. Those conservative portfolios have been hurt by interest rates. But on the other end of the spectrum, what do? They say, well, I'll get you more return. Well, that generally takes more risk. It's like, okay, we want to focus on there. Well, let's go take a look at the second bucket. That's lifestyle. Okay, this is a Dave Ramsey concept, right? Just spend less. Why drink that high quality coffee? Just if you have a bucket of swill, you can solve all your problems. Well, nobody wants to reduce their lifestyle. Let's face it. They want a better lifestyle. So where we try to focus is let's get back to the perspective. What's your why? What do you want? And where are you being less efficient with money in other areas? Because you can't, if you need a 15% rate of return every year to achieve your goals, good luck with that, right? But if you can be more efficient, I think that's the key. And what I'm finding is if we get the conversation back to your lifestyle and lifestyle conversations and income and what do you need, that can change the conversation. It's like, well, what's the markets doing? Well, guess what? That market dropped by 20%, and you're like, it freaks me out. And again, a lot of planning is probability of success, which can change quickly on that. But if you can show them, it's like, look, your income just changed by 250 a month. Like, so what? Temporarily, we can get through this. That's behavioral psychology. We spend way too much time trying to overanalyze the parts of what we have instead of thinking about being more efficient or what we want to do in general and keeping the conversation there.
Yeah, no, I appreciate that, Doug. Megan, what about you? Like, how do you go through those conversations with people? Because I know, maybe it's easier for you. I don't know.
No, not at all. Everybody worries about money. But I mean, I think Doug is bringing up that great point, right? And I talk to a lot of clients about this, particularly my clients as we go into this time period who are about to retire or have recently retired, which is control the controllables, right? The market is going to do what the market is going to do. You cannot outthink it. I think it is best to stick with strategy, stick with your asset allocation, because if you've been running long-term cash flow models for people to retire, those models also have been stress tested in down markets. But what I talk to a lot of clients about, and I'm in the same boat as Doug, which is the things you control is how much you spend, right? And, are there things we can cut out? Or, I've also have clients that are right on that edge of being about ready to retire. I had 2 clients retire this week, right? And what I talked to them about was, well, look, either do you want to stay longer or maybe you glide retire out, right? Maybe you don't come full stock. Maybe you consult for a period of time to have some income coming in to keep you relaxed and not get caught up in market anxiety. Because, the one thing we know about Trump is we're going to be whipsawed around with data, with chaos, with flipping points of view, whether you like it or not. And so it's really important to just not get caught up on that and focus on the things you can control in this type of marketplace. And I think the other thing is, these are good moments to really think about other things that should be layered into the portfolio. So, I think a big news headline this week was Larry Fink came out with his annual letter from BlackRock. And it was interesting because he was sort of saying the private markets should be accessible for all. And, I got to think about that concept for a while before I think it's great, right? Because my challenge with everyone having access to the private markets is it's very expensive to get access to on a smaller level. But he brought up things in his discussion that I think we should all think about for portfolios. So one of the things I've been adding to portfolios for the past 2 years now is just a small tilt to infrastructure, right? And you look at infrastructure funds, bridges, roads, airports, right? Things like that that tend to be at steady eddy and really boring in a portfolio. A lot of those funds tend to throw off a pretty consistent dividend yield. Those are the things that I think in these moments you can also look at to try to sort of ground yourself. Because I think when I say, look, the bridges in this country are a hot mess and they need to be fixed, I think we're all in agreement. And so I think those types of investments are also making a lot of sense in this marketplace. And
Yeah,
they hedge against inflation.
I actually wanted to follow up with you, Megan. I had a question because one thing that came up in the conversations we talked about, he mentioned like basically private equity being the same as smaller microcap, and I hadn't thought of it in that frame. But let me ask you, because I know you do a lot of private equity, and it's certainly a big deal now. A lot of people want access to it, but like, what's really the difference? I mean, why would you buy private equity and your stuff's locked up and you've got all these overvaluation problems when you could just buy a smaller microcap? Like, why would
Yeah, I
people do
mean,
that?
typically, so private equity tends to go through cycles. So what we're seeing more right now is not buying in the microcap space, but more leverage buyouts in the middle market space. So, for a lot of our clients, I think what they're hoping is that the illiquidity premium makes it worth staying in these investments. But again, it's whatever you feel more comfortable with. I could see someone deciding to do microcaps versus private equity. Private equity comes down to the manager and who you're getting access to. And I would tell you 80% of private equity funds out there are absolute crap. And you'd be better off staying in the public markets in microcaps and in small caps versus going into private equity. So I would tell people when it comes to the private markets, you have to be even more selective than ever before. And Doug brought up this great point about the small cap market. I find the small cap market a hard market to index in, right? I think it's 44% of all companies in the small cap market are not profitable. That doesn't make me excited to go invest in it. So I think where people have to think about it is things like large cap, S&P 500, you can't get better exposure than that. But where you need more thought and more focus on is in asset classes like small cap, international developed, emerging markets, right? Real estate, like REITs, where active management can make a lot of sense and understanding what pockets they're investing in is really important. I had last year, a lot of my clients do pretty well because our emerging markets manager avoided China. It had China, but they were not heavy on China. And the index is over 25% China. So being thoughtful about exposures and actually paying for managers to me is worth it, especially in a market like this.
Can I add something on that? It
Yeah,
actually
please do.
dispels huge myth. So we know there's a company out there, not to name names, but everybody knows who they are, and they're all about indexing only, cheap indexing. Do your own thoughts on this. So everybody basically loves to tout. It's kind of like the book. There was a book about dads and that might be wealthier and less wealthy. You might know that book too. I don't know if you. Okay. Everybody's like, just invest in real estate. That's not what he said in the book. Right? He said, if you actually read the book, he said, this worked for me, but for you, it might be something different. Very similar to what we're talking about today. That the next opportunity or valuation might be somewhere else in the future. It's like, don't ask what's worked, ask what's underappreciated, has more upside, than downside. Okay. Going back to this behemoth index company, everybody tells me, you should just index everything. That is actually not what they have said. They have put out white papers essentially reflecting exactly what you just said, Megan. It said, look, we're talking like the big stuff. There's 500 companies in the S&P. Like, good luck with that. And it's a momentum and market cap driven index. So you're going to always be at a momentum play of winning what's working. But they very clearly have said in other areas that could include, but may not include things like fixed income, international, small caps, where you have thousands and thousands of different investment choices that's an area where active management, which this company does have active managed portfolios that they run, active management may be your better play. So the other thing is, again, you need to know what you need to know. But how many times you go out on FinTwit and this and that? It's like passive everything, index everything. Really? Because your deities, your priests of that world are saying that is not true. But people love sound bites. Going back to the sound bites that are causing our volatility right now.
Where's Barb when we need her?
Right? Oh no,
Barb.
absolutely. Like, we've had few
Yeah.
conversations
Yeah.
like this.
Yeah.
So
But I also think this is also a good time to consider if you need help from a third party advisor. This is a really good time to seek help because so many of us are living this day to day, but we're also know to be more unemotional and grounded about it. And also, I mean, I don't know about the two of you, but I feel like we've been through COVID crisis, 08, 09, 2002, like so many different crises. Everybody feels it's different this time, but I mean, it's different, but it's, still the same in a lot of ways. And that's why I think asset allocation, diversification, and at times active management are really key to a portfolio.
yeah,
Yeah, it's funny. I almost said that to Dan just out of we get off on another topic, but I was like, is this time different? Like it's I don't know. It's we live in interesting times. I'm very curious though, what you guys think because I mean the market has been overvalued for a long time. It's technically, I guess it's Liberation Day today. It's April 2nd. We're recording this, and I think this will come out in like 2 weeks. But tariffs haven't been implemented yet. But what does everybody think about this? Like, not politically, but just like if you had to handicap this, like, where do you think this is going? How do you manage expectations and portfolios in a time where nobody can predict Trump? I mean, I don't even think he can because he's playing a game. It's not a bluff because he'll go through with it, but in a sense, it's also kind of like, all right, here's what we're going to do. You know what he's going to do. You just don't know how it's going to end up or how we get there. Like we may know where it ends up, but we don't know how we're going to get there. So how do you handle this with portfolios?
I mean, some of it is just managing client expectations, right? I don't think Trump is wrong in saying that tariffs are a negotiating tool, but they tend to be more about sort of short-term tactical and acting quickly. And so, where I think that clients or all of us who are, in this economy have to be aware is we're raising the US effective tariff rate quite high, right? Back to really where it was back in the 40s is ultimately where they see it going. And so when you think about this and you look at the data coming out from places like Yale Budget Labs, the bigger concern is tariffs are going to impact all of us. For low income Americans, you're going to see, them spending probably $1,000 to $1,200 more due to the tariffs. High income households, $3,400 to $5,000 more. Now, I bring this up because the Fed is very focused on the consumer. How is the consumer doing, with both the hard and soft data? And I think what the Fed is concerned about is we're starting to see defaults on auto loans. We're starting to see challenges in credit cards. And now we're going to layer in the tariffs. And so this feeds into this idea that unfortunately it may slow the GDP down, slow growth down in the near term. And we may have an increase in inflation by 1 to 1.25%. So setting expectations for people, I think, is really important. And I think for our listeners, that just means also keeping in mind your cash reserves. I think having a good cash reserve, sitting in a high yield savings account, earning your 4% is great as we sort of let this play out. But I'm curious, Doug, what your thoughts are.
real similar to that. There's a reason that we've talked about this before, Kirk and I mean, Warren Buffett's sitting on what, 600, $800 billion in T-bills and cash. Um, when markets are doing this, okay, unless now if you want to be an options trader, it's a great time to be an options trader. But you better know what you're doing. And the one thing they'll tell people that anybody that's good at options trading will tell people is you better have a plan, right? You don't just go into it buying options because options can be extremely expensive and they can blow you out. And the other thing is a lot of options when you trade these, they're going to create short-term interest and income. And then, how much work do you have to do? If you're going to minimize your risk on it, you have to actually have less return opportunity, which means you got to spread out a lot of different options. And then, how many of those do you have to place to make a decent return and at the end of the day, get 50% of it taxed? It's like, it's up, it depends. It's like grocery store model, really. It's like, I got to sell but billions in volume to make it. Here's what I think. I think cash was, I like what Warren Buffett says, like, what does cash do? It gives me options tomorrow, right? I think there's a big misconception between buying the dip and being able to take opportunistic advantage, and a lot of and or dollar I'm sorry and dollar cost averaging, and a lot of people confuse that too. It's like, well, I'm buying the dip. No, you're dollar cost averaging. Buying the dip is actually having accessible liquidity that you can take and move in a seismic move when there's an opportunity to buy. Most people don't have that, and they never will. But they say, well, I buy the dip. No, you're just, that's not the same as dollar cost averaging. You got to be able to know when to have something off the table so that you can have those. And there's two different tanks. People don't want safety because it doesn't pay you enough, because they look at what returns. And I see this all the time. It's like, hey, I can make this interest in the market. That's not interest. That's rate of return, and actual return and average returns can be very different. Sequence returns, all these complexities people don't understand. So I do believe in the diversification, but it's a little bit different. I like things that are, I like adding in cash, but I like adding in cash with upside. I like things that have indexed opportunity. So it's a cash equivalent, something that might be structured, but you can get market rate return. So if the market goes down, you don't lose. But if you do, you could have 100% potentially of the upside of the market. It's going to be, there's give and takes on all that, but there are so many things out there. You see, this is bad, this is good. No, there's no such thing as good. There's no such thing as bad unless it's fraudulent. That's a different story. Having more of different things that could get exposed to different things. Most people have all their money in basically three things. Equity investments, whether they're tradable or not, or private equity, fixed income, and cash. That is not the only place to play. You know, some of the calmest people in this world have pensions. There's, and it's controversial. There's annuities, there's life insurance, there's structured products, there's private equity, there's cash, there's investments. And all of those things are like clubs you can take off the rack to play your golf game. I don't play with just a driver. I don't play with just a putter. I don't play with just a pitching wedge, right? And there may be a club in there I use once every summer when I'm playing golf. But when I need it, when I'm in that really tight lie, I'm glad I've got it in the bag. And that's where you got to figure out on the driving range what the appropriate swing for you is, then go to the club rack and add those things in.
Yeah, that's great. So, one final question for each of you, and then we'll wrap it up here. And the final question, we'll keep it short and sweet. If you had to put all your money in one in one allocation bucket right now, given what's going on in the world, where would it be? Where do you think, Megan?
Oh God.
You came back. You see what all
I'm
the
gonna
things you
laugh.
missed?
I mean, I so love real estate, but I don't love. I would probably say in a high if I I would probably say international right now. I mean, most of my portfolios between emerging and developed are about 20% international, but I really like the managers that we're invested in. And I do think as the world shifts, I think we're going to see other economies do well. So
Awesome.
that's where I would say right now. That or cash.
Okay. Yeah, I like cash too. Go ahead, Doug. What's your speed round decision? What do you think?
Playing the fifth. There is no one thing. Um, Honestly, if I were to look at where, what are the benefits, right? If I want return, but I want safety, but you like real estate. I like real estate, but it's illiquid. I mean, a lot of people, I mean, I know people have gone bankrupt multiple times investing in real estate, right? If I had to say, and this is a real controversial take, one place to put my money where I could get tax efficiency, liquidity, upside down, it'd probably be a properly funded cash value life insurance policy. And I know people are like, no. Well, yeah, well, 95% of them aren't properly funded. And that's the problem. And they're not the right people. But if I'm going to look at, okay, you give me one place to put it, and I want to be able to get to the money if I need it. I want tax efficiency. I want to erode that. I want upside, not downside indexing. And if something happens to me, my family's taken care of, it'd probably be that. But again, you're telling me to pick one thing. I like it. It's not what I would do if you were sitting down with me and say, we should do that as the one-stop solution, because we're talking about go to the driving range, then go to the club rack. But The problem is there's pros and cons of every club you put in your bag. So, which one has all of the most benefits on that? Probably that if it's funded right, which is why bank-owned life insurance, that's where banks put their money, right? They get it. They want liquidity, they want to be able to lend it out. But, that's that I said, there's a controversial take there because you're asking a question that I would never respond to, and there is no perfect
Of
choice.
course. Well, that's why we're asking it,
Yeah.
Doug, because we
Yep.
know there's context around everything and there's disclaimers around
Absolutely.
everything. And
Absolutely.
we have a bunch of two-handed economists on the show today. So, on the one hand, on the other hand, I get it. Like that's what we
Yeah.
do for a living.
But
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 I just asked the question because I just want to get people's no, my answer is just what Megan said, cash. Like
yep.
I'm short-term treasuries. I think I love gold, but gold's kind of taken a little bit of a ride. I love international value, but if we go down, it's going to take them down. So I'm sitting on the fence here too, but there's nothing wrong with getting 4.25% a year with virtually no risk. But you miss out on opportunities. So I don't
Yeah.
know.
So
I just
what's the agreement on all that? Both whether that they're all cash equivalents.
yeah,
That's the key. I put it
yeah.
in cash equivalents with the most flexibility.
All right. Well, Megan, let's wrap it up here. Final thoughts. Where can people find more about you?
Yeah, diversification has been very, very helpful through 2025 so far. So stick to your allocation targets and let the uncertainty play out. You can find me and my book, All the President's Money, at allthepresidentsmoney.com, and check me out on C-SPAN. You can see me on The Presidency, which is my lecture at the Gerald Ford Presidential Museum from back in February. Kirk, thanks for having me on.
Yeah. Thanks for coming on, Megan. Doug, final thoughts from you.
Yeah, thanks. My final thoughts are flexibility. That's the key thing you've got to be right now. Nobody has a crystal ball, and if they did have the crystal ball, using the crystal ball would be the worst thing they could do. Selling it would be better. Okay, that's it. If you could sell that, I'd replicate it. So you need the flexibility, and therefore having something that, like Warren Buffett says, gives you the opportunity to make choices tomorrow is the best place for you to be right now, and that's going to mean having a full bag of options, clubs, all different clubs. Think outside the box. Don't just follow the canned advice out there. Most of the people listening don't have ordinary income. Don't follow ordinary advice. You need something for you. And that, by the way, is going to be a translation for me on what we do. I am a president and founder of Emergent College Advisors. And what do? We don't just do college planning. We are financial wealth planning first. I've done a number of webinars recently, and you know what's been the take on all of this? The messaging that's been well received. What we're talking about is different than everybody else. Why? Because we're talking about the people who are trying to pay for college, who have money, who have assets. Guess who's forgotten out there? There are systems for people that can't afford college. There are colleges that'll pay for everything. And there is certainly the billionaires out there that, they would never pay. But most of the people that make a great income, people that, make several $100,000 up to a couple million, they are getting screwed. Okay. And the reality is, when you start talking 2 to 3 kids looking for an expensive and nice college to go to, you're talking the potential of fleecing yourself of millions of dollars long term in wealth. Okay. That hurts. A lot of people are making, because if you make a good income, you probably have a higher lifestyle. You've got a lot of impact, and you probably got kids that are probably high achievers that are looking at places that are going to cost more than you would like to pay, and it's going to be more than you'd like to pay. So go, figure out how to protect yourself. Start with, go to mergentcollegeadvisors.com, MERGENT, collegeadvisors.com, and start getting yourself educated on how you can have a plan that benefits the position you're in.
Great. Well, thanks, Doug. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.